Are you looking for a way to make money that doesn't involve working for someone else? Trading options might be the perfect solution for you. In this video, we will discuss the secret to success when trading options that 90% of the traders don't know about. We will also provide some tips on how to manage your options portfolio effectively so that you can achieve long-term success. Trading stock options can be a lucrative way to make money. If you're willing to learn how to trade options correctly, then you can see some impressive profits. We discuss what is the options edge and key to trading options successfully long term. How do you reduce risk in your options portfolio? And how do you manage your portfolio effectively for long-term success? Real quick, guys, please hit the like and subscribe buttons below as well as comment and let me know your thoughts on the video. Also be sure and grab the free Simplified Options Strategies Trading Guide. I'll put a link down below. It covers the different strategies, setups, how and when to put them on, max profit, and trade management. It's a great guide to have by your side when trading options. So let's get started. To be a successful trader, you need to have an edge or something that gives you an advantage. This is true in anything, but it's especially important in options trading. The options edge is the key to success when trading options. It's what gives you the ability to make money even when the market is going against you. How do we accomplish this? We sell premium. To begin with, most traders focus on trying to predict the price direction of a stock. Price is just one of the factors that goes into the pricing of stock options. In the short term, it's a coin flip. Since the market is extremely efficient, stocks and the market have a 50-50 shot of moving up or down in the short term. Price is the one factor that we cannot control nor effectively predict in the short term. The other two factors in options, in addition to price, are time and volatility, or IV, which is implied volatility. We want to use these two factors to our advantage to give us our edge and increase profits and reduce risk. When we sell options, we are selling time premium for taking the risk of being assigned the stocks. We are acting as the casino versus the gambler, and the house always wins. By selling premium, we can make money no matter what the directional move in the underlying stock is. If the stock goes up, we make money. If the stock goes down, we still make money. And if it stays neutral, we make money as well. This is best accomplished by selling options with high IVR, or implied volatility rating. What is IVR? It's the number that shows how volatile the market is expecting a stock to be. The higher the IVR, the more expensive the option will be. This is because when there is more expected volatility, there is a greater chance for the stock to make a large move. We want to sell options when IVR is high because we want to be able to sell them at a higher price. This gives a greater chance of success because we will make money even if the stock doesn't move in the direction we want it to. We can collect more premium and go wider with our strikes to allow for more movement in the stock or underlying. Let's take a look at this strangle in Starbucks. It's trading at $87 and has a high IVR of 69. So we can go all the way out and sell the 77.5 put and 97.5 call. This gives us a 68% probability of profit or chance that the price will end up inside our short strikes, so we keep our premium. We are going 44 days to expiration. 30 to 45 days to expiration is the sweet spot that we like to sell premium in. We can collect $237 in options premium when we place this trade. You can see that the stock price has remained within the short strike range for the past 5 months. It's important to remember that options are a decaying asset. This means that they lose value over time. The closer we get to expiration, the faster the options will lose value. Have you ever heard of someone being right on the direction of a stock and still lose money? Do you know someone who buys options? Inevitably, due to time decay, if you buy options, you will eventually be correct on the direction of a stock and still lose money. Time decay is why it's important to have a plan for managing your trades. There are a couple of keys to managing your options portfolio effectively. The first is to have a diversified portfolio. This means you shouldn't put all your eggs in one basket. You should have a mix of different types of trades so that you can weather the storms when the market doesn't go your way. Rather than have only trades in technology companies, you should have a mix of trades in different sectors like energy, healthcare, finance. This will help to diversify risk and give you a better chance of success. We should also look to have a mix of strategies, some short, some long, and many neutral. This way we can profit when the market moves in any direction. The other key to managing your options portfolio effectively is to have a plan in place for each trade. This includes having an exit strategy before you even enter a trade. Rather than shoot for 100% profit on every trade, we should aim for a more realistic goal. A good rule of thumb is to aim for 50% profit on each trade with most strategies like naked options, vertical spreads, strangles. However, if we make 25 to 30% in just a few days, then we should look to take profits off the table to reduce our risk. We will then have more money available for another trade opportunity with high IVR. We also need to roll our losing trades at 15 to 21 days to expiration. This gives us much more time to be right and for our trades to come back while collecting additional premium. There are a couple of numbers that are very important when managing our options portfolio: delta and theta. I go into some depth on these in the video, Use the Greeks to obtain an options trading edge. I'll link to it down below. Since the market is extremely efficient, stocks and the market have a 50-50 shot of moving up or down in the short term. For this reason, we look to stay delta neutral. By doing this, we're hedging our bets and giving ourselves a chance of success. Theta is the amount that an options contract will make if selling, or lose in value each day if buying. This is due to time decay. This is why it's important to have a plan for managing trades. If we don't manage our trades, then we will get eaten alive by theta if we are buying options. However, we know our edge occurs when we sell options. Even though theta increases as we get closer to expiration, this doesn't mean that we should wait until expiration to close our trades. We want to take profits off the table while the risk of expiring in the money is still fairly low and in check. For this reason, we look to close trades at 50% or 25% if it hasn't been too many days. So we want to keep our theta number high when looking at our entire portfolio. We can do that on the Tastyworks Trade platform. I'll put a link down below and you can get a free offer when you open an account. It's the best options trading platform out there right now. Your brokerage should also have a place where you can see the total delta of your portfolio. We should keep neutral or close to zero as possible. Theta should be available to see as well, so you know just how much you're making daily at all times, just due to time decay. Alright guys, please hit the like and subscribe buttons below, as well as comment and let me know your thoughts if you have any questions about selling options premium. Also be sure and grab the free Simplified Options Strategies Trading Guide. I'll put a link down below. It covers the different strategies, setups, how and when to put them on, max profits, and trade management. It's a great guide to have by your side when trading options. Thanks for watching and see you in the next one.